Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And welcome to About Money. We're talking about money today. We've got so much to cover. You know, we say that history does not repeat, but that it rhymes. There are lessons to be learned. We've been saying since 2016, 7 years ago, we started talking about the potential for inflation. And yes, it's here. And yes, people look back on the 60s and 70s and look at what happened during that period of time, and we think they're looking at the wrong kind of things. We think that there's some lessons to be learned from what happened in the 1960s and 70s that you should be aware of, that you should be preparing for. Better to prepare for the worst and hope for the best than to prepare for the best and experience the worst. We're going to talk about that. And with all this going on, the market, with inflation, with the debt limit, with banks failing, with politics, with all the scare tactics, what are people doing? You know, annuity sales had record set, fixed annuities, fixing in long-term income, oftentimes for the rest of your life. What that has is the potential to be damaging. We're going to talk about that. And as people talk about the recession and bad news for the market, some people have been forecasting a recession for a year, over a year and a half.
More like 2.5 years.
2.5 years. Forecasting weak revenues. So what's happening with companies? What is going? Are we seeing weak earnings? To some extent, but how do they shake out? And then one of the big topics that that has been talked on the news a lot are the number of mass shootings. We're not talking about the political aspects or the moral aspects of it. We think there's an economic cost to be understood, and we're going to be talking about that. But first, let's talk about inflation. Since 2016, we've been saying inflation is coming, and it did get here. The Taylor Principle says that in order to cure inflation, you have to increase the Fed short-term rates, the Fed funds rate, to a level above the rate of inflation. And we're there now. And maybe another quarter point, probably not. But that's, when you look at it, all the talk has been about the inverted yield curve, about the Fed raising rates and what happened when the Fed raised rates in the 1960s and 70s, and in previous times when rates have been raised and the economy sunk into a recession. But we've also been saying, if you look at what's going on, we have almost 6 million more jobs than we have workers. The rate of inflation is coming down, but very, very slowly. Spending continues to happen by the consumers, and GDP is positive. It's not going negative. So what is the outlook? We think there's a lesson to be learned from the 1960s and the 1970s. If you look back at that time, inflation had started to pick up in the early 1960s. Not very much, a little bit. It was 1%, 1.5%, 2%. Cut up to be 6%, and William McChesney Martin, the chairman of the Fed, began to raise the Fed funds rate. And they began to curb inflation. And the economy was sinking into a recession. And so when Nixon appointed Arthur Burns, the idea was to deal with the recession and not so much with inflation. But there's something else that was going on in the world beyond what was happening to the U.S. economy. If you look at where we were, I want to take you back to the 1960s. The 1960s and the world as it existed. You had the Soviet Union and the United States in a Cold War. And one of the main areas of focus was the Middle East. Iran has been a deadly enemy of the U.S., but that changed. At the time of the 1960s and into the 1970s, Iran was our best ally in the Middle East. Israel, of course, too. But Iran was there. Iran was being the leader in Iran was the Shah of Iran. Now, if you go back in history and remember what happened, the Assyrian Empire lasted for almost 1,000 years. That was based in that area. That was followed by the Babylonian Empire. That was followed by the Mede-Persian Empire. Iran sees itself as the inheritance, the descendant of the Persian Empire. And the Shah of Iran really wanted to rebuild the Persian Empire. And he needed the help from the United States. And the United States was furnishing that help. We put a military base there. We saw Iran as our number one ally in the Middle East. Today we talk about Saudi Arabia. We talk about some of the other nations. But in those days, in the 1960s and the beginning of the 70s, Iran was our number one ally. And Iran was beginning to build up militarily. And what did they have to pay for the armaments that they were buying from the United States? Oil. They had a lot of oil. And so every year, Nixon or Kissinger or both, and Kissinger traveled to Iran on a regular basis. But Nixon and Kissinger came up with this trade. They would trade military equipment and set up these contracts for Iran to buy military equipment from U.S. companies, and Iran would supply oil. And all that was negotiated. All that was done through backdoor negotiations. It was never public. We only know about it as the documents became public a couple decades later. Now we know what went on. But the Shah wanted military equipment. Kissinger and Nixon were all in favor of that because they were our ally in the Middle East. They controlled the Middle East. And we were willing to set those contracts up with oil for military equipment. But the Shah's appetite for military equipment continued to increase and increase. And he needed more and more oil revenue. And these were non-public negotiations that were going on. And as the U.S. economy was coming down in a recession, there was concern that more oil and price increases of oil would kick off inflation. And so Kissinger and Nixon began to resist what the Shah wanted to do, because the Shah not only wanted to increase the amount of oil, he wanted to increase the price of oil. And when there was enough pushback from Kissinger and Nixon, the Shah helped to organize OPEC to create even greater leverage. And you know what happened in the 1970s. Oil prices continued to increase dramatically, driving inflation to not only double digits, but almost to 20%. That changed the world order. The Middle East became the world and industry changes, and that had a dramatic impact because no longer could we take this kind of passive focus on bringing down inflation at the same time we had a recession. We ended up with what was called stagflation. Now, the point of all this, we think there is a point to all this. And we don't think that it's going to be oil. But if you think about it in larger terms, we had a bout of inflation. The Fed is moving up interest rates to deal with inflation. We're getting some recession. Now the Fed is beginning to relax some, bringing interest rates down. And then we get a geopolitical event. It wasn't an economic event. It was a geopolitical event. It wasn't driven by economics. It wasn't driven by business. It was driven by one man wanting to rebuild the Persian Empire. And that was a geopolitical event that while inflation was becoming under control, while the economy was in a recession, but probably would have been coming out, had there not been an oil shock, things would have returned to fairly normal. So the point of all that is this. We live in a world today where we had inflation beginning. And you remember, it didn't go immediately from 0 to 5% or 9%. There was some time that it took. And there was some transitory inflation. And as the Fed began to raise interest rates, we began to see inflation, at least the transitory inflation, come down. And what we're seeing now is inflation in retreat. Slowly, very, very slowly. And we think we're going to have inflation continue for a long time. But the danger is this. The danger is another geopolitical event. And it won't be oil. Maybe it's a war. Maybe it's a comet. Maybe it's a volcano that erupts. Maybe it's a terrorist attack. But there's the potential of having a geopolitical event which sends inflation soaring again. That's where we are. The danger is not that inflation comes down. That's all positive. You don't have to prepare for inflation coming down. You have to prepare for what happens if we have a geopolitical event. Been talking about inflation since 2016. We're hoping we give you some insight because we want you to begin to prepare for the worst and hope for the best. That's where we are. We go back to look at where we were in the 1960s and 70s, learn the lesson from that. Not that it's going to repeat, but we think it could rhyme. Don't go away. We got more to talk about in this whole thing. So hang on. Don't go away. So much more to do.
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
Like you were talking about the geopolitical in the 70s, what happened with oil.
Yeah.
Right, that exacerbated inflation. And we kind of saw that last year with Russia, with the war in Russia.
We did.
And we're potentially, a lot of people, predicting on the brink of, what's going on with China and Taiwan. Another thing could pop up that could send inflation soaring again. Those are two that I can think of, those that, if that keeps going on and spills over somewhere else, I don't know.
These are events nobody really thinks about because they are unusual. They're geopolitical events. And you raised a really good point, the war in Ukraine. Who would have thought that was going to happen 2 years ago?
Yeah.
Or take the pandemic. Who in 2019 thought we were going to end up with a disease that would kill over 1 million Americans and kill how many, 10, 15 million people worldwide? These are things that just happen. Things that have never happened before happen all the time. We keep saying that.
Yeah, and just what's going on between China and Taiwan, one of them wanting to annex Taiwan back into China and Taiwan resisting. Who knows where that's going to go?
It could be a complete embargo of they could stop shipping all goods to the U.S.
Yeah. We're already seeing that we talk about inflation, but the two types of the cost push and demand pull, and the cost push of that there's still some bottlenecks in the supply chain. It hasn't really all figured itself out yet.
So there's a lot of places where we could have something blow up.
So where do you hide, Mike? In the mattress? You put your money in the mattress?
A lot of people are doing that.
I know. Not in the mattress, though.
Not in the mattress. They're doing it in the annuities.
And annuity sales in 2020 were better than 2008. Blew 2008 out of the water. One reason, though, Mike, I believe, is that they lobbied to put them in 401k.
Yep.
And there was a time that Fidelity was lobbying to put crypto into a 401k. Now, you can't buy a stock or a bond in a 401k, but you can we'll have annuities and crypto. That doesn't seem to make a lot of sense, does it? Two extremes, right?
Yes. Actually, there's a way to do stocks in a 401k.
Not in a traditionally how it's set up.
But not traditionally set up.
You got to go a little bit. There's a few hoops to jump through.
Yeah. We do it.
We do it, yeah.
And we have a way to figure out how to do it, and it's worked out very well for our clients who do that. But you're right. And there's two things about annuities. One is that they're very, very complicated and difficult to understand.
Depends what type they are. It's about three different types. You got a fixed annuity.
Yep.
And it's actually, that one's real simple. You put $100,000 in there and they give you a 5% interest and that's it. You let it go. But the problem is you get surrender periods, usually like a 10-year surrender period. So if you try to take your money back, then they're going to say, okay, we're only going to give you $80,000 or $85,000 or whatever the surrender.
But if you also read the fine print, it may be 5% today, but it could drop to 3%.
It can, yep.
And while they talk about it being guaranteed, we've seen insurance companies go out of business.
We have, yep.
And in those cases, we've seen instead of getting the regular monthly payment, the payment's reduced by 60 or 80%. Mm-hmm. And there may be a pause in the amount of money that's being paid out. So for me, that's complicated.
It is complicated. It is.
In a bond, if you buy a bond, you have that income coming in unless the bond defaults. But the chances are if you've got a good bond, it's not going to default. You know when the maturity is, you know how much money you're going to get, you know how much you're going to get at the end. Mm-hmm. And nobody's going to be able to change the amount of income you're getting.
No, but the one that I think a lot of people are getting put into is variable.
Yeah.
And they're extremely complex. I mean, the prospectuses on them are 100 pages.
Yeah.
And they're loaded with fees that you can't really break apart. They're so complicated to break out the fees and what they actually cost. I had a client that brought me one of his spouse's variable annuities to look at it. I looked at it, calculated the cost. She bought it in 2009. Her rate of return was 4.8% over the last 15 years. Yeah. When the S&P 500 did 13%. That's a huge number.
But there's one huge advantage to annuities. At least for financial advisors, you make a lot of money if you sell an annuity.
The commission's good. Trust me, I used to sell them. I know. They can be from 4 to about 8%.
There are some annuities that pay up to 14.
Yeah.
Why would somebody buy an annuity where the investment advisor is going to get 14%? You have to ask how safe that is. But annuities tend to be a hard sell.
Well, what they sell them on, the idea is a guarantee. They say, they sell them on these ideas of guarantees and that you can get your money, and that they have these like high watermarks that if this market drops down, if you put 100,000 in and the market goes up to 100, it goes up to 150,000, then drops back down. We'll keep you at the high watermark, and you can keep that 150,000. That's not really actually true in a lot of them, because a lot of them it's based off of taking income. They'll use the high watermark if you decide to annuitize the annuity, but if you want the money back, they're not going to give you the 150. They're going to be like, oh no, it's only worth 125 or 124
Or 100.
or 100 or 98 or whatever.
So but we're seeing annuity sales off the charts.
And they think 2023 is going to be better. If you want to look at it, if you're more interested in it, go to a website called LIMRA, limra.com, and they can tell you all about annuity sales. And you can go see. They're the industry, just kind of, I don't know how to describe them. Basically, just kind of an insider the industry. They do studies on annuities and life like that.
And if inflation is under control, if inflation continues to come down and interest rates continue to come down, it's a great thing. But you have to weigh that against the probability that other things happen. And the point of the first part of this program we were talking about is geopolitical events happen. Things that have never happened before happen all the time.
And that's the thing about the other point about annuities, Mike, is that there's no cost of living adjustment.
No.
They used to have them with them, but they were too expensive to issue, so they don't do that anymore. It's basically if you get an income annuity and you're gonna get $500 a month, well, that $500 a month is gonna stay $500 a month for the next 15, 18, 25 years.
So the assumption is that your inflation is going to continue at close to zero, and then if inflation is close to zero for a long time, annuities are just fine. But if we look at the inflation numbers or the Social Security, for example, from 2000 to 2023, the purchasing power of the Social Security, even with COLA adjustments,
Lost 36%.
lost 36%. For the people that are on Social Security for what they buy, for the food, for the medical care, for the transportation, those costs have gone up faster than the COLA.
Yeah.
And so somebody that had been planning on Social Security with zero inflation, they've seen their Social Security buy only 64 cents of what it would buy in 2000.
Yeah. You got no flexibility, with that.
And think about that in terms of an annuity. Somebody buying a fixed annuity in 2000, if they were getting $1,000 a month, today the purchasing power of that is less than 50 cents on the dollar.
Yeah, that's what I'm saying. That's what I'm saying. There's no flexibility. There's no way to, when inflation is low and interest rates are low, the annuity payout rates don't pay anything.
Yeah. So, it's a situation where you're gambling. If you're buying a fixed annuity, you're gambling that inflation is going to be close to zero for the rest of your life or during the...
I would love to know how many of those were bought inside of 401ks, if they disaggregate those numbers and break it out and say how many of them were purchased inside the 401ks. That'd be interesting to know.
I don't know. But
I know I couldn't find it either, but I'd love to find it and see what the numbers say on that.
I know that I was at the National Association of Pension Advisors, and there were talks that people were giving about the positives about having an annuity in your 401k and having a fixed rate of income when you retired. And it all sounds so very good, but there's no inflation adjustment, and everybody's different. When you buy into an annuity, you're assuming you're going to have that rate of income coming in, and your needs are not going to change. And what we see today is when you retire, life changes.
Especially if you have a health issue.
Uh-huh.
You're going to spend the most of your money in the last 3 or 4 years of your life.
Even without a health issue, if you're healthy, you could be spending 30 or 40 years in retirement.
Yep.
Anyway, we're coming to a commercial break. Don't go away. We've got more to talk about. What to do. This is not an easy issue to deal with, but we want you to understand what the probabilities are and where the problems are. So don't go away. We'll be right back after this commercial break, and we'll talk about some of the ways in which you can prepare for a potential hyperinflation time. And if you miss any of this program, you can pick it up on About Money on YouTube. You can pick it up on our website, and you should check out our website. Check out our website, adamsfinancialconcepts.com. Be right back. So we've been painting a doom and gloom kind of picture. Sorry about that. It doesn't have to be doom and gloom. But if you're prepared, it doesn't have to be. But if you're not prepared, it can very much be a doom and gloom picture. If we have a kickoff of greater inflation, there's really no place to hide. You can't hide in cash. Cash is going to lose its purchasing power. We talked about Social Security earlier. Social Security since 2000, people have seen their purchasing power drop by 36%, even with COLA adjustments. If you have a fixed rate annuity, you've seen your purchasing power drop by 50 or 60%. No place to hide. In cash, in a fixed rate annuity, there's just no place to go with. Real estate. Real estate supposedly is inflation adjusted and will increase. The problem is when you have inflation going on and you have wages going up, the house prices increase, but income has to stay up with it. And what you get is house prices increasing more slowly than inflation rate. They do increase. Commercial real estate is sold on a cap rate, which is the reverse of interest rate. It's like the interest rate. So as interest rates go up, commercial real estate goes down because the cap rate goes up. It's like the teeter-totter with a bond. Bonds, as interest rates go up, prices go down. Gold can be a hedge. But are you going to put 70 or 80% of your money into gold? Probably not. Maybe you have 5 or 10%. As a hedge, 5% is not a hedge. 5% is a psychological thing, thinking you're gonna be out of it. No, it's not a hedge. Crypto, we've seen some of the impact of crypto. So where do you go? I mean, so you can hear people say the stock market is a great place to invest during inflation. I've heard that mentioned maybe a dozen times in the last 6 months. The stock market is the place to be if we have high inflation. Let me take you back to the 1960s and 70s where we started this program and talk about what happened. Because the stock market, the Dow hit 1,000 in 1966. It had gone from 100 in 1941 to 1,000 in 1966, 25 years later. And then inflation is beginning to creep in, and what happens? The stock market goes from 1,000 down to less than 800. And now we begin to creep back up. The Fed is beginning to deal a little bit with inflation. There's progress being made, and the market starts to roll back up. And it rolls up to almost 1,000 once again. And then it takes another drop. Because we're now moving into a recession. They're curing inflation. Inflation is going away. The market is happy about that. Oops. Now we're rolling into a recession. So the market, which was almost 1,000, now drops to less than 700, the Dow. And now we seem to be lowering interest rates. The economy is maybe seeing a positive outlook for a recovery from a recession. So the market begins to recover into 1972. And the Shah wants a 15% increase in the price of oil and wants to withhold oil. So by 1974, the Dow has plunged all the way down from 1,000 to 600, 40%. That's as big a drop as 2008. That's as big a drop as during the time of COVID.
Look at how fast it came back, though, huh?
But it came back pretty fast.
By 19, looks like right before 19, the end of 75, it's almost back to 1,000 again.
It was. And you know why? Because a certain segment of the market did extremely well. Companies like Schlumberger and Apache Petroleum and
McDonald's.
But that was a different case. That was an earnings thing. You had the energy sector that soared and carried everything up with it. Mm-hmm. And as oil prices flattened out and started to stabilize and come down, what did the market do? It turned around from 1,000 and dropped to 750. And then finally, inflation is beginning to be under control. The economy is beginning to move, and we head back up to 1,000. And in August of 1982, the market hit 1,000 and kept right on. So you mentioned McDonald's. I mean, what I gave you was a picture of the overall. Mm-hmm. Had you been invested in SPY, the S&P 500 index, that's what you would have experienced. Mm-hmm. In the Dow. You would have experienced that. But there were certain companies where they did well during that period of time. You mentioned McDonald's. McDonald's came public in 1966.
Increased tenfold during that time.
And increased tenfold during that time. Who would have thought a little place serving 19-cent hamburgers would soar tenfold? And not only would it soar tenfold, but we talk oftentimes of changes in demographics, technology, and lifestyles.
Yep.
Think of what that did for changes in demographics and lifestyles.
People were moving to the suburbs, right?
Moving to the suburbs, and McDonald's and fast food. And restaurants became a place where you went out to eat. When I was growing up, you might go for a birthday, you might go for a special event, but you didn't go out to many restaurants. Suddenly, with a 19-cent hamburger, you could go out a lot of times.
Yeah.
Pizza, hamburgers, that's what they did. But during that time, from 1960 to 1980, purchasing power fell by 70%. I mean, a first-class stamp in 1960 was 4 cents. That stamp by 1980 was 15 cents. It had quadrupled in price. A Coke was 10 cents in 1960. It was 35 cents in 1980. 3.5 eggs and were 57 cents a dozen. They had gone up to 91 cents. And milk, 49 cents in 1960 was $2.16. And if you look at one of the drivers, I had picked these numbers out a long time ago, but if you look at what's driving down the purchasing power, a dozen eggs today. I mean, you can pay $6 or $7 or $8 a dozen today. Mm-hmm. And it's only increasing. Those portfolios that sat in cash, those people that sat in cash lost 70% of their purchasing. Mm-hmm. Those people that would have had fixed annuities would have lost 70% of their purchasing power. The only place which really worked was to find those companies which were taking advantage of the changes in technology, demographics, and lifestyles. The McDonald's or Arrow Electronics, a little radio shop in Colorado that was doing radio repairs. And when the transistor came out, they realized the potential for transistors. And I can remember having a radio growing up, a little radio with transistors that were like 1/2 inch by 1/2 inch. That was a powerful little tool. Now you do transistors. You don't even talk about transistors. You talk about chips. I mean, but Arrow Electronics figured that out, and the stock soared. You know, in 1972, I bought Advanced Micro Devices. It had been at $30 a share. It had come down to $10. That's almost a 70% drop. In 6 months, it was back to 30, and I sold.
And Mike, you and I sat in a conference yesterday looking at a stock that we I don't know if you like it as much as I did. Maybe I liked it a little bit more, but it was an interesting technology.
It is.
And it could revolutionize its industry. And you're like, you know?
Yes.
And so those things like that, I'm like,
And that's a stock, that is in the electric vehicle market. There's been talk of increasing the range of an EV from 300 miles to 3,000 miles. It seemed like pie in the sky.
I think 3,000 might not in the next 10 years, but I think their technology saying that they can get 600 or 700 is huge, because that gives you at least 9-hour day of driving if you're going to drive cross country.
Yeah.
That's a big deal.
And if you can fast charge?
Yeah, they said their fast charging was, I think they said 5 minutes or something, because of the way the battery's designed. And it doesn't, I don't know all the technology. I'm not a physicist that they have working there, but it was really interesting how they explained it.
Being there in those types of companies, that is how you make it through these times where purchasing power is crushed. It's that when you have to be stock specific. It's a stock picker's market. It will be a stock picker's market.
And what's people's aversion? The volatility, right? The volatility. But the volatility is the volatility. It's always going to be volatile. Even if you're in the S&P 500, it's volatile.
Yes.
We talk about it before, is everybody thinks the safe companies are the big Dow stocks. We've seen them extremely volatile. AT&T's taken a beating this last year. The stock is down, it's down $18, dropped 50%. And that's supposed to be a bellwether.
Oh, yeah. Remember Bethlehem Steel?
Yeah.
Where did they go? They were part of the Dow. Eastman Kodak? Polaroid? Anyway, don't go away. We're going to finish this up. It's important to understand and evaluate the future, because that's how you get through these times. So, we've been talking about no place to hide except by picking specific companies that are going to have positive. But we're just coming through an earnings season, and so what's been going on? People have been forecasting, and when you listen to analysts, when you listen to the gurus, they talk about the coming recession, they talk about soft sales, they talk about earnings coming down. So what's been the record? FactSet is a company that actually produces some data, and they're saying companies with over 50% of their revenues coming from overseas have seen their revenues drop. Those companies that are domestic, less than 50% of revenues, less than 50% from overseas, have seen their revenues rising. So what's going on? Well, when you really break it down and look at what's happening, what are the companies that have seen the biggest drops in revenues? Think about it. Moderna.
Pfizer.
And Pfizer. Think about where we've just come. Those companies had huge revenues during COVID because they produced vaccines. They were the two biggest producers of vaccines, along with Johnson & Johnson, which has also seen their revenues drop overseas. And the other company that's seen their revenues drop is Intel. And we've seen a change as people have moved away from desktop computers and tablets to smartphones. That has impacted Intel's business. And maybe they'll make a transition. But for right now, that's going on, and their revenues, where they get over 50% of their revenues from overseas, they've seen their revenues drop. So what's going on? It's not all the companies that have overseas sales of over 50% are losing money. No. No. There's a few, and a few are losing enough money that it brings the entire average down. And it all comes back to the point we were making before, is you have to be, now that we're in these times of inflation, you have to be security selective. You have to be stock select. Buying an index, buying a basket, a huge basket of stocks is not going to work. The chances are that it's not going to work. I can't say for sure that it won't work, but I would say the chances are it's not going to work. And if we look at history, and we know that history doesn't repeat, but that it rhymes, in tough times like these, it didn't work. You have to be company specific. You have to be stock specific in order to come through these times that are positive. That's all we're saying. If you want to survive these times and go on and maintain a quality of life, and that's what we're looking about, is building financial readiness so that you maintain quality of life that you want to have, then you have to be stock specific. That's our view. That's where we stand. We're long-term investors. We know there's going to be a lot of volatility, and we know that not everybody agrees with us. If everybody agreed with us, we wouldn't do so well. If everybody was doing the same thing we were doing, no one would benefit. So that brings us to another topic, which is a serious topic.
It is talking about mass shootings. Why have we seen so many of them? And are they on the? And they have been on the increase.
Significant increase.
I read a lot of stuff about this, and Harvard Medical School researchers did a study and said that we're talking about the economic cost, some $557 billion annually, or 2.6% of gross domestic product.
It's a huge economic cost.
And this is a peer-reviewed study from JAMA that it's not the political arguments. It's not just about gun control. There's already too many guns. There's already enough guns out there. So even if you stop the sale, they're already there. And, one side wants to argue for gun control. One wants to argue for mental health screenings and mental health. There might be some truth to that. And I think there's truth to both sides of the argument. The people that are doing this from the studies, this one's called the Violence Project, that it's mostly if families can recognize that someone's in distress. That's what they're seeing. So they said, this is from the Violence Project. They said warning signs before an attack. In the months and weeks before the attack, many gunmen displayed these signs. 80% were noticeably in crisis. 67% showed signs of increasing agitation. 44% leaked their plans of the attack. And if they leak their plans, that's kind of like, they cry for help, right?
Yes.
And so, common traits they said they have is 44% experienced trauma, like a death or a loved one, a child abuse. 57% had criminal records. 68% had diagnosed with mental illness. 28% had received prior counseling.
It's a significant issue.
Yeah, and just to go back to the cost, and it's not just the cost of, let me find my spot here. It's not just the cost of, just the cost of the shootings and all the other costs that we can see, the unintended healthcare costs and everything like that. But what people fail to neglect, we focus so much on the people who get killed, which we should, but it's the people who get injured. Their lives and the cost to that over their life is a tremendous loss and hardship, and those costs end up actually can sometimes be more than the people who are killed, because that cost keeps on going for the rest of their lives.
And there's a cost to the businesses where it happens as well.
Yeah, from hospital bills and lost wages, lost productivity. Some place they estimate the gun violence at $300 billion a year. And you said you had a friend that had a restaurant or a bar.
I had a cousin that had a nightclub.
Yeah.
And somebody got shot in the nightclub. Now, this goes way back. This goes back 20-some years. But you know what happened to the attendants at that nightclub? It dropped off a cliff. People didn't want to come. And this was in a nice neighborhood, and it was a strange situation. I don't even recall all the details. Mm-hmm. But somebody was upset with somebody that was fooling around with somebody's wife, and they shot and killed him.
Yeah.
I mean, the impact was just dramatic. And he had a lease on the place. He had loans. He had all that.
Oh, yeah.
And the attendance just dropped off a cliff. He was doing everything he could to try to rebuild the attendance. But the reputation and the overhang from something like that.
And so I wonder what happens to a lot of these malls and stuff like that. I wonder how long it takes for people to want to go back when these things happen. The workers, right? The people who witnessed it and have to go back to work the next day or the day after.
Yeah. I mean, it's anytime you have something like that, it's almost the aftershocks. It's not that somebody else is going to be killed. It's not something, but the people just have the fear, having seen something like that, they don't want to see it again.
Yeah, I mean, it's just, this is a societal issue that we have to deal with.
Yeah.
And, this violence project, whoever this guy is, Mr. Densley, he said that over the past 20 years, along with the mass shootings, suicides and overdoses are up too. He said this isn't a coincidence that all three of those things are up, that there's something going on that in this society that needs to be fixed.
It does.
And it's costing us all a lot of money because we're paying it all through our taxes and things.
And you and I are paying.
Yes.
And the listeners are paying for it. There's an economic cost. It's not just that it's happening in Texas. It's not just that it's happening in Nebraska. It's not just that it's happening in Maine or Colorado or where that cost gets distributed around. Anyway, that wraps us up for today. We will be back to talk more about money. Do prepare. Prepare for the worst. Hope for the best. Don't just be blindsided by the things that can go wrong. There's enough of those that you can't foresee.